Hello and welcome to the fourth episode of our educational video series, The Learning Curve, which aims at simplifying complex tax issues for you. In our last episode, we discussed about tax deducted at source or TDS in case of individuals and firms. Taking the journey forward, we shall today focus on TDS in case of corporates. Chapter 17 of the Income Tax Act 1961 talks about collection and recovery of taxes. Tax deduction at source or TDS is an instrument designed for quick and smooth collection of tax and to prevent evasion of taxes. One of the most fundamental aspects to be considered while making TDS deductions is to keep in mind that it is applicable only when an income is chargeable to tax. It means if an income is not chargeable to tax at all, there can be no question of TDS. TDS provisions applicable for corporates. Let us first understand the broad steps involved in deduction of tax by a corporate deductor. Step 1. Every deductor, barring some exceptions, is required to obtain unique tax identification number, commonly known as tax deduction account number, which is an alphanumeric number. After obtaining TAN, the deductor is liable to deduct tax at the time of making payments or making entries in its books of account in relation to various business transactions. After deducting tax from the payment to be made, the deductor needs to deposit that tax in the government account on behalf of the deductee. Deposit of TDS in case of corporates can be done either by way of ITNS 281 challan or by way of e-payment through NSDL website. But for all corporate assessees and those taxpayers which are liable to get tax audit done under the provisions of Section 44AB of the Income Tax Act, e-payment of taxes is mandatory. Step 4. The time limit within which TDS deducted has to be deposited is also very important in order to save the deductor from any penal consequences. It is usually on or before 7 days from the end of the month in which the deduction is made. Step 5. After monthly deposit of TDS, the deductor is also required to file a quarterly return of TDS mentioning details of taxes withheld by it during a period of 3 months. Penal consequences. A deductor would face the following consequences if he fails to deduct TDS or after deducting the same, fails to deposit it to the credit of central government's account. A. Disallowance of expenditure as per Section 40A1 of the Income Tax Act 1961. However, if tax is deducted or deposited in the subsequent year, as the case may be, the expenditure shall be allowed as deduction in that year. Levy of interest. As per Section 201 of the Income Tax Act, such deductor shall be deemed to be an assessee in default and liable to pay simple interest at the rate of 1%. Levy of penalty. Penalty of an amount equal to tax not deducted or paid could be imposed under Section 271C. PAN of deductee is compulsory. For the purpose of deduction of tax at source, quoting of PAN is mandatory. If PAN of deductee is not intimated to the deductor, tax will be deducted at source by virtue of Section 206AA, either at the rates in force or at the rate of 20%, whichever is higher. In respect of various items liable to TDS, the income tax law has prescribed a threshold limit. If the expenditure incurred or payment made during the year is below the threshold limit, then there is no need to deduct tax at source. For example, at the time of making payments to professionals for technical service, if the total amount to be paid in a financial year is less than Rs 30,000, there is no requirement to deduct TDS. But if amount exceeds even by Rupee 1, TDS has to be deducted on the entire sum of Rs 30,001. Ultimate responsibility of payer or deductor. It is the duty and responsibility of the payer to deduct tax at source. If the payer fails to deduct tax at source, then the payee will not have to face any adverse consequences. However, in such a case, the payee will have to discharge his tax liability. Thus, Failure of the payer to deduct tax at source will not relieve the payee from payment of tax on his income. How this scheme works in practical. To understand this, let us go through the following steps. Step 1. The person deducting tax shall furnish periodic statements of TDS to the Income Tax Department in the form of TDS returns. Step 2. The above authority, after verifying the details, enters the details of TDS on centralized computer system. Step 3. The centralized system then compiles all the information inserted by the deductor and provides the same to the deductee in a simple form 26AS. Step 4. With the help of easily accessible form 26AS, the deductee could claim TDS benefit in his annual return filing. Step 5. After verification, the department may allow claim of TDS benefit, and balance tax, if any, has to be paid by the deductee or the return filer at the time of filling. Relaxation in TDS deduction. Apart from the provisions of deduction of tax at source, there are some relaxation provisions also which a taxpayer could avail for lower or nil TDS on satisfaction of the assessing officer. Reporting of TDS in Form 3CD. In case tax audit is compulsory for an assessee having a turnover of rupees 1 crore or more, he has to make disclosures regarding the compliance being done in respect of TDS in Form 3CD. Now let's see what are the major TDS amendments proposed in the Union Budget 2017. Presently, Section 194J1 provides that TDS at the rate of 10% to be deducted on payment made to resident for rendering any professional service or technical service. In order to promote ease of doing business, the rate of deduction of tax at source has been reduced to 2% from 10% if the recipient is engaged in the business of operation of a call center. In another attempt to incentivize access to foreign capital, the government introduced a beneficial TDS rate of 5% in respect of interest payments made to the non-residents. This is Section 194 LC. The provision was applicable to loan agreements or long-term bonds issued on or after July 1, 2012 with a sunset clause that the benefits would only be applicable to the agreements entered or issuances carried out before July 1, 2017. The sunset clause has been proposed to be extended to July 1, 2020. The benefits of Section 194CL has also been extended to the much talked about rupee-denominated bonds or masala bonds. Hope this information was useful for you. In the next episode of Learning Curve, we shall focus on the much awaited General Anti-Avoidance Rules or GAAR and how it is going to impact India Inc. Thank you for watching TIOL Tube. You may send us your feedback or suggestions to make it more useful for you at editor@tiol.in.